Okay, let's really unpack this. It feels like in 2025, stablecoins and these tokenized assets, they're not just some side thing in crypto anymore. They've kind of become the unexpected backbone, wouldn't you say?
Absolutely. It's really quite a shift. We're seeing this huge wave driven by, massive adoption, but also regulation kicking in, like the US Genius Act you mentioned. And that number, over $250 billion in stablecoin supply worldwide. That's pretty staggering. It definitely feels like it's reshaping finance.
It really does.
And what's key, I think, is their basic promise: stability. These are crypto assets designed to hold a steady value, right? Usually pegged to something familiar like the US dollar, maybe the euro, sometimes even gold. But it's also moving beyond just digital dollars now. This whole trend of tokenizing real world assets, or RWAs,
Hmm.
that's getting big.
Like the BlackRock fund, the BUIDL one.
Exactly, yeah. Tokenizing US treasuries.
Yeah.
It's basically dragging traditional finance, TradFi, onto the blockchain, making these old school assets more programmable, easier to access.
Makes sense. And you can't talk stablecoins without hitting the big players, right? Like Tether's USDT.
Oh, yeah, got to start there.
It's the oldest, the biggest by far. Market cap around, $167 billion. Just dominates trading liquidity. It's like the main highway for getting money in and out of crypto, that classic on-off ramp. Huge on networks like Tron, too. Over $75 billion just there.
It's definitely the market leader in liquidity, no question. But that does bring up the whole backing and transparency issue. USDT is backed by a mix of US treasuries, sure, but also commercial paper, even Bitcoin at times. And they've had their run-ins with regulators.
Right, that CFTC fine back in 2021.
Precisely, $41 million. It highlights those past concerns about, let's say, clarity. And importantly for you, the holder, USDT doesn't offer any direct yield. Tether keeps any interest earned on those reserves.
Okay, so shifting gears a bit, what about Circle's USDC? It seems positioned quite differently.
It is. Circle's really focused on transparency and compliance. Their market cap is smaller, maybe $69 billion, but their impact is huge in other ways.
Yeah, I saw that stat. Their on-chain transaction volume in 2024, over $27 trillion. That's like more than Visa and MasterCard combined.
Bet this right. It's incredible. And it shows their strategy. They're not just a stable coin, they're pushing hard into actual finance. They've got partnerships with MasterCard, Finastra. They're even going for a federal stablecoin bank charter, really trying to embed themselves in the traditional system.
So they're building bridges.
Exactly. And they're expanding too with their Eurocoin, URC, seeing good growth. But like USDT, the base USDC token itself, no native yield for you as a holder, though some platforms might offer interest.
Okay, now this is where things get, well, really interesting, maybe a bit wild. Athena's USD.
Ah, yes. The synthetic dollar.
Right, a synthetic dollar stablecoin that actually offers native yield right on the chain. It grew super fast, hit around $11.8 billion, briefly the third largest. Sounds amazing, but what's the catch?
Yeah, you're right to ask. USD is quite novel. It's not backed by dollars in a bank. It's backed by crypto collateral, think ETH BNB, and uses complex derivative hedges. The goal is to keep the dollar peg and generate yield from those positions. And its racked version, SUSD, has been paying out like 19% APY this year, which is, very attractive.
Very attractive, but sounds risky.
Extremely. There are significant risks. The stability mechanism is complex, relies heavily on those derivatives working perfectly. Their insurance fund is, frankly, quite small relative to the supply. And regulators are watching closely. S&P Global even gave it a 12,250% risk weight. Just to compare, safe assets might be 0% or 20%. So that tells you how complex and potentially volatile they view it.
Wow, okay. So pulling this all together for you listening, stablecoins are clearly vital now. They're making money faster, cheaper, more programmable. We've got USDT, kind of the workhorse for trading liquidity. USDC is that compliant bridge to traditional finance. And then USC, the high-yield, high-risk innovator.
And connecting that back to the big picture, it really hammers home the need for due diligence, doesn't it? For you, that means really looking into what you're holding, using audited platforms, maybe diversifying your stablecoin holdings, and crucially, understanding the specific risks, especially with newer models like USD. Don't just chase the yield without knowing the trade-off.
So the big question then is, where does this go? Will the big banks fully jump onto these tokenized rails? Will we see even more protocols trying to capture yield like Ethena? Or could, a market shock slow things down? How do you balance chasing these new opportunities with managing the very real risks in this space?
Something to think about.